Yeah, welcome to this afternoon's TalkPower webinar on the power market updates with James Chaplin, Senior Manager for Curve Trading. Before I hand over to James, just to remind you that we're going to record the webinar today and we'll send it out to anybody who joined live and anyone that's sort of signed up to catch up on demand after the session today. There'll be a section at the end for questions and answers from James, but do feel free to drop anything into the Q&A function as we go if there's a particular question that comes up throughout a particular part of the presentation, and then we'll touch on that at the end. And anything we can't answer today, we can direct you in the right direction or take away and come back to you offline. So yeah, I'll hand over to James. Thank you.
Yeah, cheers, Penny. And yeah, good afternoon, everyone. Thank you for joining today. As Penny said, my name is James Chaplin. I'm the Senior Manager of the Curve Trading here at EDF. So plan for today, pretty much the same as usual. We'll have a bit of a look back in what's driven the market. Now, there's been lots going on in the market, so we obviously won't touch on some of the detail, but some of the bigger kind of headlines and geopolitics has driven sentiment at times, and then touch on the fundamentals, kind of focusing on the gas side. Obviously, any questions about more detailed about kind of the power market or renewables, etc., please feel free to ask at the end. So if I just jump to a gas price chart. Now, this is slightly different to what we usually show in this webinar. So I've just added on a few different contracts here. So in yellow, we've got the Q126 UK gas contract. In blue, we've got the summer 26, and then in green, we have the winter 26. So obviously, you can see obviously they're very correlated. I touched in the end about how the spreads between the Q1 and the winter 26 have changed over that time. But first, if I just kind of touch on some of the key elements now, if you cast your mind back all the way back to April earlier this year, where you can see volatility was obviously much, much higher in the markets. That was obviously Liberation Day announcement, so US tariff announcement impacting global demand forecasts, obviously freeing up extra LNG supply for the market. So obviously not just commodity markets that crash, stock markets, etc., on potential economic downturn. That kind of filtered through the market. I mean, it's been on and off since kind of this time, but we had that other dip again at the back end of April. And yeah, just touching on it there. So that was that kind of US tariff war escalation with China, and we had the Russia-Ukraine kind of peace talks. I think probably the highest hopes that they were getting somewhere at that time, and potential some more Russian gas re-entering the market. We obviously know that wasn't the case, and there's been back and forth around kind of peace talks and sanctions ever since. In June as well, we had significant volatility, obviously a big price spike on the Middle East conflict, Israel initially shutting off some of their offshore gas fields, and I suppose the biggest threat to the market then was Iran threatening to close the Strait of Hormuz. Obviously, if that did happen, that did escalate into shutting of the Strait of Hormuz, prices would have gone up drastically, potentially even higher than energy crisis levels. Obviously, that was very low chance, but the market was having to price in some risk of that happening. We obviously got a very quick turnaround to a ceasefire announced by Trump, and therefore a big initial price fall in the market back to kind of the levels it was trading before the conflict started there. Now, ever since, it's kind of been a bit up and down. Overall trend has been bearish, but obviously still lots of volatility, just to a bit of a lesser extent, I suppose. So we've had kind of on-off kind of sanctions risk on Russia from Trump. If you cast your mind back to July, he was saying there's a big announcement. Then he kind of put a 50-day deadline on it, so that disappointed the markets. We then had the run-up to the US-Russia-Alaska summit, which all seemed very positive at the time. Another meeting was scheduled between Zelensky, Putin in a few weeks' time. Obviously, that just didn't materialize. But when that fresh kind of positive news hit the headlines, obviously it was quite bearish to the markets. And when the markets realized, it was probably a bit too good to be true, adjusting back up as well. Now back to kind of more fundamentals in September. So we really had range-bound trading. I would say volatile. It doesn't look very volatile on this market, but range-bound trading through September. Now it's quite an interesting time of year. here because we're approaching winter. Everyone's cautious around, are we going to get a cold start to winter? We've got a lot of weather risk around cold weather for the next 6 months or so. We also had lots of Norwegian planned maintenance, as is typical in September. So the market's always a bit cautious around, are they going to return on time? Are they going to be delayed, like we had a few years ago? But at the same time, we had very strong LNG supply still coming in from around the globe into the UK, into Europe, sorry. And we had kind of changing geopolitics as well. So the market really searching for direction and kind of waiting for those early October weather forecasts. Now, when we actually got into October, you see that initial dip. So that was kind of on mild weather forecast at that time. So the market kind of selling off thinking, oh, we're going to have another mild winter again, as we have the last few winters. And then we had a couple of things happen. First of all, we had temperatures again adjusted slightly lower. So slightly colder dip, particularly kind of in the UK and the Nordics around mid-month. But we had then Russia strikes on Ukraine gas production facilities. Now, this is a risk we had flagged a while ago. I think we thought it might start to happen towards the end of October, so right before the Ukraine heating season starts, but they actually started towards the beginning of the month, and they've pretty much continued from that date. So current estimates are around 60% of Ukraine gas production is currently offline, and the strikes continue. I think there were strikes on gas infrastructure both of the last 2 nights as well. So what does that mean for our markets? Why do we care, obviously, in the UK? Well, it means that Ukraine have to import more gas from neighboring European countries this winter, and therefore reducing the balances, the supply and demand balances, and I suppose forecasts for storage withdrawals for this winter. So again, just tightening the market. Latest expectations, I think Naftagaz came out and said they expect to import an extra 4 BCM of gas this winter. So I suppose we await further details around kind of how long the outages will be. I'm expecting them not to be short because they'll be tricky to fix. And obviously, we've still got the threat of further strikes. But definitely the energy war between Russia and Ukraine has increased. Ukraine targeting oil facilities, Russia striking gas facilities. Now, the other thing I haven't included on here is the recent sanctions announced on Ukraine by the US. Now, this is pretty much just targeting oil. So we did see a bit of an increase in the oil price last week. But then again, OPEC plus are going to release a bit more supply to the market. Nothing on gas. And I think the key thing here is probably Europe has told Trump they're too sensitive to gas sanctions at the moment, so they won't go that far. But Arctic 2, which is currently sadly been sending gas to China, and the US hasn't stepped in to enforce the sanctions there. So that has been one of the key barriers. Now, see, we'll touch on fundamentals a bit later in the presentation, but you can see prices, low levels for this year. I think the sentiment really is going to be driven, obviously, by geopolitics, any changes we get there, but really weather fundamentals. I think this winter is a bit in the balance. We're quite used to mild winters now. Therefore, if we do get cold risk coming over the next couple of months, that will add a bit of risk, definitely for the Q1 contracts. Longer term, past this winter, we are getting a lot of global LNG supply come to market. So, obviously, weighing on further dated pricing. But yeah, I think weather's going to be the key kind of trend setter over the next few weeks and months. Now, one of the key things I did want to touch on in this graph here, you can see the Q1, so the yellow line, and then the winter 26, the green line. You can see the Q1 was much premium market pretty much all through the year. That has come back to parity and now actually a slight discount to next winter. So all the risk premium that was in Q1 for this winter has essentially been eroded out of the market already. So again, quite interesting to see people are pricing all that risk out already, probably because we've got to winter. We know what our storage fill is. But again, we just have to see how weather fundamentals and supply turn out over the next few months. The other price chart I just wanted to touch on, I think I went over this in the last few webinars as well, is the carbon pricing. So in the blue line, we have here the UK carbon price, and the white line is the European carbon price, both in pounds per tonne, so we can compare the spread. Now, we know at the beginning of the year, UK prices are much depressed, very completely separate markets, too much supply in the UK market, so we're very low pricing. And then we've had that spread decrease. So you see the two lines, I'll just put those on. If you see those two lines have kind of converged somewhat, and that's talk of linkage through the year. So I think we got most positive linkage around mid-May. So you see that spread really tight in there. Most recently, it has widened back to around £13 per tonne spread, because I think people thinking, how long is this potential linkage of the two schemes going to take? I think the forward view here is if we do get more positivity around linking the two schemes, and it doesn't obviously take too long to do, maybe in the next couple of years or so, obviously these two markets will converge. The UK market will go up to the European market, and therefore increase in price by £13 per tonne, and obviously will be subject to the outlook in European carbon space, which is tightening or expected to tighten over the next few years. Again, forecasts from different parties around the industry can be very different. Some people expecting over 100 euros per tonne by the end of the decade. Some a bit less kind of bullish on that. Obviously, if we don't get linkage and regulation change in our market, then bearish UK carbon prices. But it does, up until now, seems that both parties want to work towards that, at least with the current Labour government. Obviously, if that did change in future, different parties have different priorities in terms of carbon pricing. So I touched a little bit on gas storage. So just the typical chart we show here in this presentation. So this is just European gas storage stocks. So we know we inject, so fill up our gas storage through the summer months, so from April, and then we start withdrawing in winter. Typically October can be, we inject a bit in October, and November is when we start withdrawing quite heavily. The red line shows this year. And I think the key thing I wanted to show here is actually we've leveled off quite a lot over the last month. Now, previous expectations and forecasts, so it's all kind of different market sources, were expectations of us to get to 86 to 90% full, which would have put us in a great place for winter. And even if we got cold, probably fine to kind of get through the rest of winter. We've only managed to get to 83% full due to a range of reasons, on some Norwegian supply outages, a bit cooler temperatures at times as well. So we are obviously trailing much behind last year. Now, we do have a lot more LNG supply coming in, so we're much better on the supply side, but it does obviously leave us susceptible to any kind of cold weather shocks, either in Europe or in Asia, anything that will increase global demand. So again, just something to watch. We do have mild weather forecasts over the next 2 weeks across Europe, so this will probably still stagnate. We won't see sharp withdrawals until nearer to kind of mid-November. But then the longer term weather forecasts at the moment see actual cold conditions from mid-November through to December. So again, that is going to be something to watch. See, weather forecasts past the next week or two become quite low confidence, so take it with a pinch of salt. But yeah, do keep an eye on any kind of weather forecast temperature changes across Europe and obviously key demand hubs in Asia, as that will be kind of key in driving sentiment. On the supply side, so I said, we're getting a lot more LNG imports into Europe. This summer, obviously, global LNG supply has increased quite significantly. This is just showing LNG imports by month and split by source as well. I think anecdotally, you can look at the chart. You can see the proportion from North America has massively increased over the last few months. So that's new projects in the US. So Plaquemines coming online. That's expected to continue to grow over the next few years as we get more and more projects coming online. So I think that a lot of the US projects look like they're on time, and they'll start delivering volumes over the next 6 months or so. There are still some concerns around if the Qatari projects will be delayed or so. But yeah, worth keeping an eye on. But I think the key message here is yeah, a lot more LNG supply. So if we sum up over the summer, so summer 25 versus summer 24, an extra 16 BCM. And over this winter, we could be receiving an extra 40 cargoes a month on average into Europe versus last winter. Obviously, that depends on the competition in the global market and any supply side issues we see as well. This is just another chart just to demonstrate. So just looking at total global LNG exports between 2013, 2014 and 2015. And again, I think hopefully easy to see. You can see we're record high in LNG exports. Obviously, without any major supply issues, that will expect to grow over the next few years as more supply projects come online. And then lastly, on LNG, just want to touch on global LNG pricing. So what we're seeing here is the black line down the bottom is the rough kind of estimate for the Henry Hub delivered cost, so taking into account freight rates as well. And then we've got in blue the Asian spot price, and then in orange the TTF month ahead. So that's the marker for European LNG pricing. Now, if you go back to energy crisis years, not shown in this chart, you'll see kind of big spreads open up because both hubs had to attract LNG at times, and that's kind of when we're chasing each other to new all-time highs in kind of pricing. Obviously, it's a bit more subdued now. If we look towards the far right of the chart, you can see it's pretty much parity at the moment. So even though Asian spot price is showing as a slight premium, it doesn't mean that cargoes are going there because they have higher freight costs and higher journey times from the US to Asia than it does to Europe. So the ARB is currently closed. So cargoes are free to come to Europe from the US at the moment. No threat of real diversions to Asian hubs. Obviously, we just need to keep an eye on that. If China, Japan, South Korea start to get particularly early cold snaps in winter, we could see those hub prices kind of change, the kind of ARB open, and ships start to go to the different hubs instead of Europe. So nothing showing that at the moment. Obviously, I think what we've been saying over the last few months, or last few weeks, is we are very early in winter here. It's still only 1st November in 2 days' time. So lots of kind of potential cold weather to come. And yeah, we just have to wait and see how that outturns. And temperatures. So, I mean, this is showing kind of last winter. So not showing kind of the forecast here. Really, this is just showing the temperature deviation to normal over the UK, Germany, and France for last winter. The key message I want to show here is just a reminder that although last winter was colder on average than the previous one or potentially 2 winters, we still had another mild winter. Now, obviously, that's the way temperatures are going with global warming, etc. But it's just a reminder again, if we did get a seasonal normal or colder winter, you're comparing demand levels not just to last winter, it was still very mild. So prolonged cold, low wind spells will have potentially a bullish impact on prices in the short term, at least. And the last one, just wanted to touch on. Don't have a fancy graph to kind of show here on kind of how much production is offline, but as we said earlier, obviously we've seen around 60% or potentially 60% of Ukraine gas production offline due to the Russian infrastructure strikes. We don't know how long this is going to be. Typically these things, it's not going to be a quick fix. It'll likely be offline for much of winter, and we have that risk of further strikes. Obviously, I said, we've had strikes both of the last 2 evenings as well. So this again, story to watch. Tightened balances in Europe hasn't really impacted pricing too much over the last few weeks because it's been countered by mild weather, still strong LNG supply. But again, we'll have to see kind of how that price impacts when or if we do get colder weather come. So hopefully that gave a high level overview of what's happening in the market and some kind of things to watch out for. I know there's a lot more detail going on, so if you do have questions there, but if I just summarize here, market very much I suppose, waiting for direction in this winter at least. We've got bearish prompt fundamentals currently countered by increased gas imports to Ukraine. And we still obviously are very early in winter, lots of winter risks still remaining. Very much, I think I've said several times, weather fundamentals are going to dictate sentiment a lot over the next few months. We're in a very mild spell at the moment. We are expected to go colder from mid-November and into December. And then obviously we'll have to see kind of what the forecasts are for early Q1 as well. Early season analogs, now again, take this with a big pinch of salt. Do see kind of an overall colder risk for winter. I think that was kind of the low zonal winds coming into winter and a few other things. But again, I think anything with weather past the next 2 weeks, very low confidence. So let's just see how that evolves. Ukraine gas production, as we talked about, I've got here 50%. I think the latest figure is 60% offline. More imports needed from Europe. We do have the threat of further strikes. And then lastly, I suppose the big bearish kind of driver is LNG supply ramp up over the next few years. Obviously, it's going to add a lot of supply in the market for the next few years. So potentially tight winter. And then are we going, is this LNG supply going to come save the day? I suppose the one, I suppose outside risk in my head is, what does demand do over that time when that LNG ramps up? Are we going to get price sensitive buyers return to the market, increase demand in Asia? And I suppose what does AI do in terms of AI data hubs, increasing demand in these hubs as well over the next few years? That's all from me. I suppose just open for any questions, please.
Thanks, James. That was great. We do have some questions coming in. So we had some submitted ahead as well. So I'll try and group these together as best I can, but any that kind of come in. So please do feel free to drop more in the chat now, and I'll go through those in order. But if we start with kind of the market dynamics and volatility. So what trends are you seeing in renewable generation and how are they impacting power market volatility?
Yeah, so obviously renewable generation is increasing by massive amounts year on year. Obviously decreasing overall power prices in relation to gas on the forward curve. So you see that in the clean spark spreads, how they've evolved over the last few years as well. Obviously, when we get to the prompt, the volatility is far higher, really driven from wind forecasts. I think even in October, when we had Storm Amy towards the beginning of the month on the weekend, we had the whole weekend baseload price outturn near zero, and obviously lots of negative pricings in there. And then, we've seen lots of times in summer where we've got that solar peak, particularly on the weekends, pricing going negative as well. So, I think it's just going to obviously drive more volatility in the market until we get, more balancing units, batteries, gas peakers kind of on board. I suppose, one of the risks, I touched on potentially cold weather upcoming in mid-November. One of the risks flagged is, I'm going to say this terribly, Dunkelflautel, where we get, extended period of low wind, low solar. So I suppose that's one of the downsides when you go too much on that side. Well, you need kind of still those flexible units for now to balance. But definitely more renewables is driving more volatility in the prompt. But overall, on the curve, it is decreasing power pricing relative to gas, and you can see that in the clean spark spreads.
Thanks, James. And a bit of a question. So what is the current situation with Rough storage facility?
I think it is closing down. I don't know what the latest is, if it's fully closed now or it is just emptying its cushion gas and decommissioning, unfortunately.
Okay, and so why have we seen so little LNG arriving in the UK this past year?
So I don't really think it matters too much how much LNG is coming into the UK, and that's why I think when I show these charts, I'm looking at Europe overall because we've got the interconnectors. Typically in summer, UK is the discounted market versus European hubs. So if you're an LNG player, you're going to get more money to deliver into continental European hubs. You also might have kind of the long-term contracts there as well. might be lower costs at going into TTF, French hubs into their terminals. But yeah, typically UK has lower pricing because we've got low demand and we've still got all the supply from the North Sea coming in. So we're actually net exporters to the continent in summer. In winter, that's when I expect we'll start to, or the UK will start to see higher LNG deliveries because again we'll go to the premium hub in the European market and we'll have to be importing from continental Europe, or at least getting that LNG supply to help balance our grid.
Thanks, James. And then next one in this kind of category. So what degree of price risk is being factored in from the current low levels of storage in the UK going into winter?
So I suppose, yeah, UK storage is very different to kind of European storage. European is long-term storage, so in pretty much overall just injects through summer, overall withdrawals just at different rates in winter. Europe, obviously, without rough, is all now medium range storage, so MRS, and we can fill up within a couple of weeks and completely withdraw in a couple of weeks. So yeah, obviously that'll impact prompt pricing spreads between kind of day ahead versus next week, or UK versus continent to incentivize storage withdrawals or injections. But yeah, I wouldn't worry about it impacting scarcity of supply just because it doesn't really matter in terms of what our storage levels are. We've got the interconnectors with Europe. I expect them still to fill up to quite high levels over the next few weeks in this mild spell. So that I think if you're a storage operator, you'd be filling up in early November and then looking to sell a bit further down the line on optimize. So yeah, I wouldn't be too concerned around that.
Okay, thanks, James. So next question we've got. So as prices are gently coming down, are there any particular price levels you're keeping an eye out for that we may see significant demand construction at?
No significant price levels. Yeah, I think the market will ultimately always be driven by fundamentals. I think the unknown in the market is there a price level in the Asian markets where you get price sensitive buyers come in and start buying a lot more LNG. Now, and that level will change depending on oil price and fuel prices, etc. And I don't think it's really known. I think people have been throwing around, $10 per MMBTU or $9 per MMBTU, where you get a bit of extra demand. So yeah, no exact science on that, and nothing we're keeping an eye on ourselves at the moment.
Thank you. So next question around sustainability carbon. So what's the long-term view on carbon prices and how they may impact on the markets?
Yeah, so as I said earlier in the kind of carbon price, UK is carbon price is going to very much depend on any news of linkage we get. If we do get positivity around linkage in the next couple of years, obviously we're a £13 discount to European carbon prices, so that would be £13 per tonne bullish. If linkage talks break down, then that will be very bearish to pricing as well. Longer term forecasts from around the industry and kind of European carbon pricing is obviously the market is expected to tighten. That's how the market works. They want higher carbon prices towards the back end of the decade to help reach their kind of net zero targets. So longer term view for European carbon would potentially be bullish, depending on any regulatory change, and obviously that will be driven by new governments in or so. I think in the UK specifically, it'll be linkage. And I suppose by the time the next election comes around, what the political party at the time is wanting. We had the Conservatives came out and said they would potentially scrap carbon pricing if they got elected again. Again, that's a long way away. They're not doing too well in the polls, so read into that as you wish. But yeah, European carbon pricing pointing upwards towards the back end of the decade, but it is driven by regulatory news, etc.
Thanks, James. So next question. So what can we expect from French nuclear generation over winter? So YOY capacity is trending much higher this winter compared to past years, but how does this filter into actual generation?
I don't think I've got too much opinion on that at this time. Hopefully good good output, good production. We know French prices are, consistently discount to UK. So, providing they have good output this winter, yeah, UK should be importing through most periods of the day through the power interconnectors there. But yeah, no insight on the French nuclear output.
Okay, thank you. And then one of our guests has just said, sorry if they've missed this, but are you seeing an impact from the Russian ban of LNG import from 2027?
Not really, no. So it's not taking any supply out from around the globe. So it'll just mean a rebalancing of supply. So Europe will be taking more US, West African, or Qatari cargoes, and Asia will be taking, particularly China, India will be taking more Russian LNG. Um, Now, it would be an issue if there was a lack of supply of tankers, so LNG tankers, because tankers might have to do, particularly Russian ones, might have to do longer journey times. But that's not expected. So as there's enough tankers, it won't impact, or very minimal impact in any pricing, because the market supply will just rebalance itself.
Great, thank you. And then slightly different sort of question, and I know you did touch this in your summary, so a bit around in AI and the impacts you might have on the power markets.
Yeah, so I mean, yeah, I touched on. I mean, I think that's just my personal uh, interest or point around kind of data centers. That you see news articles of massive data centers being built in the US, and I'm sure in China and some other countries over the next few years. Obviously, that's going to increase power demand in those countries, and I suppose, does that then increase gas demand at all? Or is that going to be fed by kind of renewable or nuclear power? So again, yet to be seen. Data centers may be increasing demand towards the back end of the decade. That is just my personal insight. I don't have any market research on that. Other bits, I know, I mean, looking at weather forecasts, you are getting AI come in and get more involved in kind of weather forecasts and looking to, they forecast more often, quicker every day, and potentially show changes to weather trends before the main other models do. So that's something we look at here at EDF. But yeah, I'm sure there's going to be lots of other aspects in terms of forecasting, particularly on the weather side, where AI is particularly helpful and gives a bit of an earlier insight into the market.
Brilliant, thank you. And then we did have a pre-submitted question, but this one I think will be more for one of our other webinars we've got coming up. So it was around the government's clean flexibility roadmap. So we do, just before we finish the call, we'll flash up the next webinar, but we have one on strategic energy policy and strategy on the 12th of November. So that'd be a good one to dial in for that query. I think the last question we have in the chat, and this might be one we can reach out to you after the session. Just saying this is their first webinar they've dialed into, and they just like to understand the graph you showed at the beginning a bit more, what the different lines and figures mean. But perhaps, yeah, we can share something with you, email something out to you after. So I think that's kind of, yeah, that's all our questions that we've had come in. So thanks so much for your time, James, as always. It's the last one of this year, but these are the next ones, the last power market one for this year. These are the next ones we've got coming up. So like I say, we've got the strategic review of energy policy, looking back at 2025 and into 2026 on the 12th of November. And then we've got our non-energy costs explained webinar in December. So do head over to the TalkPower page on our website if you'd like to sign up to those. When the call ends, we'd really appreciate your feedback. You will get a survey pop up just so we can keep making sure we're delivering the content that works for you. Yeah, that's it for today. Thanks, James, for your time. Thanks, everybody, for dialing in.
Thank you.
Thank you. See you again.